Okay, first comment that came in is using the market sentiment tool, that's a light buy. If I still am contrarian and concerned that the market is going to be bearish, I can still trade bear call credit spreads even though the market sentiment tool is going into a light buy. Well, the answer, of course, is yes. But I want to give you some hesitation on that. And what I mean, of course, is there's a lot going on, as we mentioned, and we're seeing the light buys here. In general, let me go back in time once more here to that market sentiment tool that we talked about. In general, I don't usually try to switch from bullish to bearish or from bearish to bullish, but let's say I don't try to switch from bullish positions I'm in to bearish when I start seeing just these light sell warnings. What I typically look for is 2 strong bearish sell warnings to really trigger what I want to see of maybe lightening up on my bearish positions, managing my bearish positions, or moving from bearish out to bullish. And I don't really navigate that much. I'll talk about that in a moment. I switch that much. And on the bullish side, hey, a light buy is encouraging right now. But what I'm really looking for here as a leading indicator for a change, here are some of the light buys that we got. Yeah, those ones there sort of triggered this movement up. What I really want to see are these bullish buys, 1 or 2, really 2 bullish buys in a row, just like 2 bearish sells in a row or very bearish sells. And that tends to lead to more of a longer term, more strategic sentiment change. And I usually want to wait to see that change and see the SPX maybe have that MACD crossover to the positive in addition to seeing these bullish buys on the market sentiment tool as well. So right now we have the light buy. We're not seeing the MACD that I particularly want on SPX or maybe even QQQ or NDX to do that. Now, the idea behind bull put credits and bear call credit spreads is that you can always find bearish securities in a bullish market. And you can always find bullish securities in a bearish market. But then we also have to consider the other analogy, cliche, if you will, that the rising tide lifts all boats. So even what was bearish might not be bearish. Can you find strong bearish positions? If you're looking to do bearish positions, you're bearish on the market, maybe you want to do some shorter term weekly or 2-week out bear call credit spreads. When you see the light buy warning come in and say, hey, maybe I should hesitate. Well, the answer, of course, is yes. I go into bear call credit, I go into search, not that one, that's a VIX weekly calls, don't use that right now. But the weekly bear call credits, there's only one position that comes out, and that's kind of risky, but it is a 237, 240 on Tesla. And, what we're looking for here is positions that have a strong probability of staying below the position and not having earnings between now and expiration, and stocks trading below their 20-day moving average with a negative MACD crossover at least 1 day. Things that are projecting bearish positions, things that are projecting bearish techniques, but with the option structure we're looking for being at least 10% of the money, having an 80% probability or higher of expiring worthless, some vague open interest. So the answer is yes. But you still want to have your triggers in place. And if the market starts to turn, as we mentioned, you want to be aware of that adage and that cliche of rising tides are going to lift all boats. So some things are going to start recovering. You might want a lower beta position for a bear call credit spread, still getting the return that you want, still having that theoretical probability you want with the trend that you want. That's the power of the search tool in all strategies. You can search by the stock, trend, and stock criteria, fundamentals, and technicals, in addition to screening for the various option criteria that match your risk-reward tolerance in that given strategy as well. Now, that being said, I want to go back briefly, and I want to go into the view indicator details, and I want to check out the sentiment history one more time. I thought I could go back to July 20th, but you can see what happened. If I would have entered positions on or around July 20th as the market was ramping up, and I think, hey, things are looking good. Oh, here's this sell warning here, but that's okay. Things are still looking good. How would have bull put credit spreads performed in that first 1 or 2 weeks and the next 2-week cycle and so forth? But this is more directly related to your question. We can go back to 821. So instead of doing the bull put credit spreads, the market's been declining. It's been moving down for about 20 to 30 days. Say, hey, I'm still bearish on the market long term. I want to continue to do bear call credit spreads that have that good probability, stocks that are in that fundamental and technical downtrend. I've got 10% out of the money. What if we ran the bear call credit spread the last time we saw the light buy warnings? Yeah, it's going to be on around 820, 821. So let's switch it up. Let's do that. How would that have performed? The question coming in, I'm still bearish on the market, but I'm seeing the light buys. Is it okay to still enter bear call credit spreads? Well, again, my answer was yes. Still want to find positions that you're bearish on, but now let's do the bear call credit spread. Let's do the back test. Let's use that August 21st, farthest date back we can go, when that last light buy warning appeared. And let's use those weekly bear call credits we saw that we're looking 14 days out in time, 10% out of the money, 80% probability, while still looking for a reasonable return on the position. Now, I must state that this might take longer than usual. The reason why is because right now in the background, we're uploading all of today's closing option and stock data into the historical data tables. So as a vast amount of data is being pushed in, we're interacting with the historical data table to say, hey, where's my trades from August 21st and the bear call credit spreads? And we see here the top results using one result per security. So some extras on Tesla, Carvana, Coinbase, Wayfair are filtered out. So this is when the market was trending down. We started to see light buy warnings on or around August 20th or so. Here's our preferred weekly bear call credit spread search with that 80% or higher probability. You see some probabilities in the 86, 87, 88 range. Some returns from 9% to 25%. How would we have performed from August 20th to the 1st of September, 11 days out in time, when that light buy had triggered? Well, not too bad. We had an 80% success rate, but the average return was minus 7.2%. And that's because of these two positions, Carvana and SCMI. Now, following our general rules for management techniques on the bear call credit spreads and bull put credit spreads, what we always recommend, in addition to having some management set in to close the positions or manage the positions, if the technical indicators you use reverse, stock now goes above the SMA 20 for a bear call credit spread. We see a positive MACD crossover as the stock starts to recover or reach the 1% rule. Both of these positions would have likely been closed out if we entered all of them at a 50% loss. That's our general rule. There's management techniques you can use, but usually it's best at that point if you hit that 50% loss of the maximum, you usually want to close out the positions. These two might have only been 50% losses instead of 83 and 100%, but it still performed pretty well with the 80% rule. This probably would have been a slightly positive return, limiting this to 100%. If we only took the top 4 trades, which is normally what I'd usually do in this portion of my account, and I must suggest that if you're trading credit spreads, iron condors, for example, out of the money credit spreads, iron condors, then you're looking for that 12, 13, 14% return, but that means you're probably risking 7 to 1, 8 to 1 against the position, highly leveraged positions, even buying options where you can lose 100% of what you invested in the position. You should likely only be trading that with 10 to 15, maybe 20% max of your total portfolio value, because unexpected events will happen. And you want to make sure that you're not too much. But let's take those out. We take just the top 4. Hey, we're still down 6.7% with a 75% win ratio. And again, we would have limited this to 50% loss, probably closed it out before taking that 83% maximum loss. But I think that still would have put us at the negative. You know, it would have been at about 46.3% positive, 22, and the 18 puts us at 56.3%. My apologies. And loss of 50%. So we would have made 6.3% with a 75% success rate. That would have been to September 1st. That would have been Friday, September 1st. Let's do this again. Let's see what would have happened if we ran the bear call credit spread default screen on September 5th. Why September 5th? Well, that's the Monday following that expiration date where our positions were closed or liquidated or adjusted after the Labor Day weekend. That's why there's 4 days there. So again, let's submit that search. It might take us a little bit, as I mentioned before, to get into the results here. So it's going through that, and let's just see what our second cycle would have been. So let me jot that down. We're going to call it a profit. What did I say? We would have had 56.3% up and 50% down. So we would have been at a profit of 6.3% for that first cycle with a 75% success rate. Wow. No positions were found on September 5th that matched our criteria, whether it was related to earnings or whether it was related to the market was changing pace and no stocks were below the SMA, not many stocks were below the SMA 20 and had that negative MACD that still were 10% out of the money, had the 80% probability and the minimum 9% return with no earnings between now and expiration. Let's limit this down to 7%. Just want to see if something pops up. It could have been earnings related. It could have been other related. Let's just see historically if we can find something a little bit less of a range out of the money, but still keeping that 80% probability, that 9% return. We get 1, CMPR. Let's just calculate the group results on that one, 9.9% return. So now we're 100% at a 9.9% return on the position. Okay. So successful, yes. Concerns, yes. Now, let's be fair and square. That was the bearish ones. Let's look at bull put credits. Why again? Remember, we are talking about on August 20th, we started to see that light buy recommendation. And we showed that, yes, you could probably trade bear call credit spreads after the light buy, even though the market had recovered from August 20th and was moving back up from that lull, there were still some bullish positions. Let's go into bull put credit. Similar criteria for the 2-week out preferred weekly bull put credit spread, 80% probability, no earnings between now and expiration. Looking for a positive MACD and stocks trading above their 20-day moving average. What bull puts would have matched that default criteria on August 21st when the light buy came in? Following the trends, following what we're seeing in the market sentiment, hey, we got a light buy. Maybe we want to consider doing some bullish spreads on this position or on this market. My apologies, I should say that. But as always, any of these strategies, avoiding earnings between now and expiration. So we've got 5 positions, slightly different than what we saw. Celsius, Arista, Annet, Eli Lilly, Amgen, and NVO, Novo Nordisk AS. Of course, as we did before, let's go ahead and calculate those group results. That came in rather quickly. And from August 21st to September 1st, light buy warning, those default 5 positions, 5 out of 5 were profitable or 100%. Light buy warning going in. And from the 21st to September 1st, average return of 11.7%. This is above the 6.3% we saw for the bear call credits. Now, as we did before, we go to the next cycle. We've got to go to September 5th. I don't think this is going to be as good, by the way. I don't think this is going to perform as well from September 5th to September 19th, based on how September was, even with the criteria that I prefer to use. Even though we didn't see the negative market sentiment come in during that time period, it stayed at neutral after it lulled. But hey, this is why we have the backtest tools to help you test your ideas, test your theories, see what's happening. So what bull puts would have come up that following Monday after Labor Day, after we did our 4 or 5 positions for the bull puts. We've got a lot of stocks now trading above that 20-day moving average. We probably would have only taken the top 4 or 5. I'm scared. Let's see how these performed over that first 11-day time period to September 15th from September 5th. Well, 10-day period, really, because we lost the day due to the Labor Day weekend. I'm scared. Yeah. Well, it's still a 77% success rate, 23 out of 30 trades, or 11.3%. So with the bear call credits, when the light buy hit, we had a 75% success rate with a 6.3% return, assuming that we closed for a 50% loss. And then, of course, we had the one trade that was a 9.9% return. Same time period, bull puts, when we saw the light buy, 5 out of 5 trades were successful for a positive 11.7% profit. Then we had a 77% success rate with minus 11.3. But again, we likely would have only done the top 3 or 4 trades. We did 4 with the bear call credit. So let's just take the top 4 for a bull put credit spread, assuming it matched our criteria and everything along those lines. I'm just going to remove all these. I know it's a little bit painstaking to do the clicky. Bear with me one second. All right. Okay, so again, we would have had the 100% loss here on MDB, but when we hit that 50% loss level, on the position, let's see here, we were at a 2.5 point position, and we initially received a net credit of 33 cents. So the maximum loss was going to be about 217, if I'm not mistaken. So monetarily, we would have closed the position when we hit a 50% loss. It probably would have been right here, a day before expiration, as a stock supply. So what this shows here is just change in SPX. Hey, we did have a max return of 10. Wow. Sorry, 4 days before expiration, we had a max return of 10.6% before the stock really started to eke down. But here is sort of the option prices versus the stock price. And on the 11th here, we see the stock was at 394. We could have liquidated for a 10.6% return on the position when the max return we were expecting, I think, was 11.3%. That probably would have been close to 80% of the maximum profits. Another rule we follow. We might have actually closed this one for a profit beforehand. But if we didn't, we would have closed it here, taken about that 47% loss, 47% of the maximum loss on the position, which means going over here, adding all this together, let's just call this 16. So that's 32.3, 49.9. So 49.9% positive minus 47 loss. This still would have been about a 2% return, again, with a 75% success rate, similar to what we had on the bear calls. But then, of course, we would have had a 100% success rate with 11.7. And again, why are we going through this exercise? Because it was that question that came in of, if I'm still bearish on the market, is it okay to trade bear call credit spreads even though I'm seeing a light buy? We looked back where we could go to August 21st here with the backtesting tools, and we saw a similar light buy. And for the bear calls, that first cycle from August 21st to September 1st was a 75% success rate. And calculating in that we would have closed that one position that of the first 4 that would have hit the 100% loss, we would have closed it for only a 50% loss. We are expecting a plus 6.3% return. In the following cycle from September 5th to the 15th, that 10-day expiration, instead of 11, we lost a day for Labor Day. We had 1 trade, but we had a 100% success rate, and the average return was 9.9%. So what were we doing? This was when we had the light buy, the last light buy recommendation, and we showed that we did find bearish positions following preferred criteria when the market turned from that bottom on August 20th and moved back up before it started to decline again. But following the light buy on August 21st, the last light buy series, doing the preferred bull puts, what did we see there? Well, the first cycle we had from 8/21 to 9/1, we had a 5 out of 5 successful trades, 100% success rate, with an average return of 11.7%. And then on the next cycle, it was 3 out of 4 trades successful. We had the 75% success rate when we just took the top 4 trades, looking for the 80% probability, and assuming that we took out the 50% return as we did here. If we didn't hit the 100% loss, we took only the 50% loss. We were at a 2.3%, 2.4% return, I believe. So here we're at 14.1. I know you just can't add up the returns because this was 3 trades and this was 1 trade. You average that differently, but just adding up the numbers here, and this would have been about 16.2 if we just add up the numbers here. One trade here and 5 trades. We had more trades that matched the criteria. So the success rate was still kind of there, even though this was only for one trade. I want to make sure that we're clear on that. But 75% success rate versus 75 and 100. Hey, that kind of averages out to the probabilities we want to see and need to see for credit spreads, 83, 84%, what we typically see with those ones. It illustrates that you can find bearish potential stocks for those potential bear call credit spreads, even if you're seeing light buys. If I start seeing that go to a stronger buy, John, the stronger buy signal is the very bullish buy, I might pull out of those bear calls. But here we also saw that we still managed to do well in the bull puts in that first cycle, 5 out of 5 instead of 3 out of 4 for 11.7 and 6.3 in the first cycle. But then the market did start to turn. We didn't see the bearish signal that I expected to see in the Market Sentiment Tool, but the market did start to turn and hesitation was there. And as we saw, of course, remember that 75, this loss here that we took, that 50% loss on MDB, I believe it was, 3 days before expiration, we could have closed it for a 10.6% return when we were expecting a max of 11.3%. I'm sorry, the max of MDB was, I'm looking for the other view and I can't find it. I'm sorry, folks. Anyway, I think this was, 33 cents off of 217. Let's just do that real quick. I think that was the 11% max return. We could have closed it for 11.3. What have I got here? I'm sorry, folks. So 33 max off of true risk of 217 on a 250 spread. That actually comes out to 15.2. So 10.6%, pretty close to 80%. If it was 11.3, I would have closed it. But if it was a 15% return, I likely wouldn't have closed it when we got there. So we're going to take the 50% loss in that case and compare those numbers. So John, yes, you can, but I encourage you that you use the proper criteria. It doesn't have to be my criteria, but in addition to looking for, hey, I want something deep out of the money and a high probability or certain short option delta, make sure you're following and looking for stocks that match the trend you need and are desired for a bear call credit spread or a bull put credit spread. Okay? And we've got the default searches, as I mentioned for you, that we just showed for you to use as a stepping stone to create your own personal search, adjust the fundamentals or technicals to meet your needs, things such as RSI, if you want to use Bollinger Bands or percent Bollinger Band ranges, stocks, instead of the stock below the 20-day moving average, if you want to use stocks where the 20-day is below the 50-day or the 50-day is below 100, you can do that as well. For example, it's just something we prefer. You want to use different MACD. The number of days the stock has crossed above or below the SMA 20 or SMA 50. Fundamentals, any credit spread, bear call credit, bull put credit. I encourage you to use the filter for no earnings between now and expiration. But if I'm doing bull puts, hey, I might look for ones that have a positive earnings per share growth, maybe mid to large cap instead of small cap stocks for a little bit more security. Back in the technicals, I might use a higher average stock volume as well to make sure it's not something that's fly by night or just has limited average stock volume over the last 90 days where any influx of activity could cause it to swing wildly one direction or the other.